When the dust settled on the 2008 financial crisis, the United States government authorized a massive transfer of wealth, $475 billion. That was the price tag of the TARP bailout. While millions of ordinary Americans watched their homes slip into foreclosure, the very executives who engineered the toxic mortgage market were walking away with their annual bonuses intact. If that sounds familiar, it should. A century earlier, the unchecked speculation of the Roaring '20s operated on the exact same logic. Brokers extended massive amounts of margin credit, pumped up worthless stocks, and left retail investors holding the bag when the market crashed in 1929. Technology has evolved. Trading has moved from chalkboards to fiber optic cables. But the foundational blueprint for elite financial theft remains entirely intact. Create complex credit, hide the underlying risk from the public, and when the bubble finally pops, force the taxpayer to cover the tab. To understand exactly how this modern grift is executed, we have to look at the energy company Enron. In the late 1990s, executives Jeff Skilling and Andy Fastow built the prototype for the corporate financial mirage. They started by manipulating the books. Look at this animated chart tracking corporate revenue. With a technique known as mark-to-market accounting, Enron took their long-term, 20-year projected earnings for energy contracts and began compressing them. They simply declared those massive future projections as immediate day-one income, generating a colossal fake profit spike. But real business operations still generate real costs. To keep their mounting debts from dragging down their soaring stock price, Fastow set up thousands of special-purpose entities, essentially corporate shell companies. They shuffled hundreds of millions of dollars in red ink entirely off the public balance sheet. This was impossible to pull off alone. Wall Street's most prestigious gatekeepers were heavily involved. Institutions like Citigroup and JP Morgan designed complex prepay transactions, legally disguised as commodity trades, which allowed them to covertly loan Enron $6.4 billion while reporting it as operating cash flow. When the dot-com bubble burst and the true numbers surfaced, Enron collapsed almost overnight. Shareholders lost $74 billion. Public pension funds in Ohio and Florida were decimated. And Enron's auditing firm, Arthur Andersen, was caught desperately shredding documents to hide their complicity. Congress rushed to pass the Sarbanes-Oxley Act, introducing stricter auditing rules. It successfully placated an angry public. But while regulators focused on closing the accounting loopholes of the 90s, Wall Street was already engineering a much larger, far more dangerous scheme. The breaking point for that new scheme arrived quietly. On December 14, 2006, Goldman Sachs CFO David Viniar spent 2.5 hours reviewing the firm's mortgage portfolio. He noticed a persistent 10-day stretch of losses. The subprime housing bubble was beginning to leak. By 2008, that leak became a flood. Bear Stearns acquired a government-backed rescue, AIG needed a massive taxpayer bailout to survive, and Lehman Brothers, hiding its debt with Repo 105, filed for the largest bankruptcy in history. Global liquidity shattered in a matter of days. The implosion wasn't an accident. Some financial instruments were deliberately designed to fail. Goldman Sachs Vice President Fabrice Torre helped structure a synthetic collateralized debt obligation known as Abacus 2007 AC1, specifically loaded with toxic subprime mortgages. Through this complex setup, hedge fund manager John Paulson bet against the very product Goldman was selling to its clients. Paulson personally pocketed $1 billion in profit, while ACA and other investing banks suffered nearly identical billion-dollar losses. These intentional imbalances defined the 2008 crisis. Financial institutions engineered products that magnified the risks of the housing market, while simultaneously betting on those same products to fail. This internal conflict of interest ensured that when the system buckled, the banks remained profitable, while the public was left to manage the $475 billion fallout. While the mortgage crisis was consuming the major banks, a secondary crisis was exposing the regulators. For 2 decades, former NASDAQ chairman Bernie Madoff ran an exclusive investment fund. He routed $150 billion through a single Chase Manhattan bank account to fake a steady, seemingly impossible 1% monthly return. To maintain the illusion, Madoff relied on associates like David Kugel. They used their legitimate expertise in arbitrage to systematically fabricate and backdate thousands of trade confirmations. On paper, it looked like flawless investing. In reality, new client money was simply paying off old clients. The Securities and Exchange Commission had the mandate to stop it. Financial analyst Harry Markopoulos sent the SEC multiple reports in 2000 and 2005, explicitly proving Madoff's returns were mathematically impossible. The SEC received at least 6 detailed complaints over a decade and ignored them all. The scheme only fell apart because the 2008 liquidity crunch forced investors to panic. When Madoff's clients suddenly demanded $1.5 billion in withdrawals, the illusion broke. He only had $300 million left in the bank. Madoff's theft persisted through decades of reviews that failed to perform the most basic task of auditing, independent verification. By accepting Madoff's self-reported data as truth and failing to cross-reference his records with third parties, the SEC allowed a multi-billion-dollar mirage to operate in plain sight. When the dust settles on these engineered disasters, the pain is strictly distributed downward. Wisconsin state employees alone lost over $45 million in pension fund assets in the Enron collapse. Working families lose their life savings, while the elite architects face minimal fines and negotiate private settlements. Look at this animated chart mapping the scale of modern theft. This fraud leaderboard visualizes the damage. $74 billion wiped out in Enron's equity, $8.7 billion missing from FTX customer accounts, $6.4 billion in Enron's hidden prepay loans, $1.2 billion in actual losses for Madoff investors, and $1 billion extracted through the Goldman Abacus deal. After 2008, lawmakers introduced the Dodd-Frank Act, adding new layers of compliance. But without stringent individual criminal accountability for top executives, the rules act merely as suggestions. Wall Street simply hires better lawyers and adapts the grift to newer, faster technology. If a financial institution can secure $1 billion through deceptive reporting, and the resulting regulatory penalty is a $50 million fine, the law ceases to be a deterrent. The fine simply becomes a heavily discounted cost of doing business. And that brings us to the present. In 2022, Sam Bankman-Fried and Carolyn Ellison took the exact same cycle of fraud and rebuilt it for the digital age. Through the cryptocurrency exchange FTX, they systematically misappropriated $8.7 billion in customer deposits. They used those funds to cover massive trading losses at their hedge fund, Alameda Research. To hide the $8 billion hole in their balance sheet, they propped up their assets with highly illiquid, internally generated FTT tokens. Despite this devastating collapse, aggressive political lobbying is currently pushing to weaken SEC oversight even further. The explicit goal is to funnel highly volatile, difficult-to-sell assets, like cryptocurrencies and opaque private equity funds, directly into the retirement plans of millions of ordinary workers. The mechanisms are faster and the assets are digital, but the blueprint remains intact. A new speculative bubble is actively being engineered, and once again, retail investors are being positioned to take the fall.